Module 5, Financing Your Small Business. Module Overview. No matter how brilliant a business idea is, without proper financing, it is like a car without fuel. It won't move. Financing is the lifeblood of every business. In this module, you will dive into the complex, diverse, and evolving world of business finance, equipping you with strategies to not only secure funds, but also manage them effectively. Financing isn't just about getting money. It's about choosing the right type of money at the right time, under the right conditions, and ensuring the funds are used wisely to create sustainability and growth. This module addresses where to find money for your business, how to pitch for financing, balancing equity and debt, managing cash flow and credit, avoiding financial traps that cripple many small businesses. By the end, you will understand that financing is not a one-time activity, but a continuous process of funding, managing, monitoring, and leveraging resources to sustain business growth. Section 1. Understanding business. Financing needs. Before seeking money, entrepreneurs must clearly identify startup costs, registering the business, equipment, branding, initial inventory, marketing, and staffing. Working capital, daily operational expenses, rent, salaries, bills, materials. Growth and expansion costs, scaling up production, opening new outlets, investing in technology. Contingency funds, reserves for emergencies, downturns, or market shocks. Many businesses fail not because money isn't available, but because entrepreneurs do not quantify exactly how much they need and for what purpose. This section emphasizes the importance of budgeting, forecasting, and mapping financial milestones before looking for funding. Section 2. Sources of financing. Financing options can be broadly divided into internal and external sources. Internal sources, personal savings, the most common and accessible funding, shows personal commitment, friends and family contributions. Informal but must be documented to avoid conflicts. Retained earnings, reinvesting profits into the business. External sources, bank loans. Traditional, structured, but often requires collateral. Microfinance institutions, suitable for small businesses with limited collateral. Government grants and schemes, subsidized programs encouraging entrepreneurship. Venture capitalists and angel investors. Equity-based, ideal for scalable and innovative businesses. Crowdfunding platforms, raising funds from a large group via online platforms. Cooperatives and trade associations, rotational savings or cooperative financing. This section teaches you that no single source fits all needs. Instead, entrepreneurs should build a funding mix tailored to their business stage and goals. Section 3. Equity versus debt financing. A critical decision in financing is choosing between equity, selling ownership, and debt, borrowing money. Equity financing pros: no repayment pressure, brings mentorship and networks. Cons: loss of ownership, shared profits, slower decision-making. Debt financing pros: retains ownership, predictable repayment, tax benefits. Cons: risk of default, interest burden, collateral requirements. Entrepreneurs must balance the two, often starting with debt, small loans, microcredit, and gradually considering equity as the business scales. Section 4. Cash flow management. Securing funds is only the beginning. Managing them is the real battle. Entrepreneurs must master cash flow, forecasting, predicting inflows and outflows, accounts receivable and payable management, ensuring customers pay on time, and negotiating supplier credit. Cost control, avoiding unnecessary spending, emergency reserves, always keeping a buffer for shocks. Many businesses fail not because of low profit, but because of cash flow mismanagement. This section emphasizes daily financial discipline, record keeping, and financial literacy. Section 5. The art of pitching to investors and lenders. Accessing finance requires more than asking. It requires convincing. Entrepreneurs must learn to pitch effectively. Clarity of business idea, simple, compelling, problem solving. Market evidence, show demand with data. Financial projections, realistic revenue, profit, and break-even analysis. Exit strategy for investors, how they will make returns. Professionalism in delivery, confidence, honesty, and enthusiasm. This section prepares you to negotiate loan terms, attract investors, and build credibility with financial institutions. Section 6. Common financial mistakes in small businesses: borrowing too much too early, mixing personal and business finances, ignoring repayment schedules, underestimating costs, relying only on one funding source, failing to keep proper records. Avoiding these pitfalls is as important as accessing funds itself. Case study examples. A small bakery in Lagos secured a microfinance loan but collapsed within 2 years because the owner mixed business profits with personal expenses. A shoemaking business in Aba crowdfunded online, expanded production, and gained foreign buyers, proving that alternative finance sources can accelerate growth. Module summary: financing is not just about securing funds, it is about planning, choosing wisely, balancing options, managing money smartly, and avoiding mistakes. Every entrepreneur must view financing as a strategic tool that sustains, scales, and secures business longevity.